The strange truth about modern banking is that your bank does not need to find someone else's dollars before it can lend dollars to you. If a bank approves you for a mortgage or a business credit line, it does something that feels almost illegal the first time you understand it. It records a new asset, your promise to repay. Then it records a new liability, the deposit in your account. On your screen, money appears. Not paper money, not gold, not a bag of savings from a vault. Spendable bank money. That is the part people describe as banks printing money from thin air. And in one narrow accounting sense, they are right. But in the more important economic sense, the phrase is dangerous because the money arrives with a matching debt, with risk, with capital rules, with settlement pressure, and with a clock ticking. So this video is about the trick itself, how commercial banks create money through credit, why repayment destroys that money, why the central bank is still in charge of the system, and why this power can build houses, fund businesses, inflate asset prices, and occasionally turn the entire economy into a balance sheet problem. Start with the most familiar misunderstanding. People imagine banks as warehouses for money. Depositors bring money in, the bank stores some of it, lends the rest, and earns interest. That story is comforting because it makes banking sound like coat check with spreadsheets. But modern banking does not work like that. A bank can lend first and look for reserves or funding afterward. The Bank of England has been unusually blunt about this. In the modern economy, most money is created by commercial banks when they make loans. The loan does not wait for a pile of deposits. The loan itself creates a new deposit.
Imagine a small bank approving a $100,000 business loan. Before the loan, the bank's balance sheet does not contain that customer's new money. After approval, the bank has a new $100,000 asset because the borrower owes the bank. At the same time, the borrower has a new $100,000 deposit. The deposit is money from the customer's point of view. They can pay suppliers, salaries, rent, or taxes with it. Nothing physical had to be printed. The bank expanded both sides of its balance sheet. Asset up, liability up. The borrower gained spendable money, and the economy gained a new deposit. That is the core mechanism. Banks create deposit money by creating credit.
But the next sentence matters just as much. Banks create money, not wealth. The borrower is not richer in net terms. They have cash in the account, but they also owe the bank. The bank is not magically richer either. It has an asset only if the borrower can repay. If the borrower defaults, the bank takes a loss. This is why the system is powerful, but not supernatural. Credit can pull future income into the present. A family can buy a house before saving the full price. A company can build a factory before it earns the revenue from that factory. A city can finance construction before taxes have been collected. Credit moves time around, but it does not erase the future. It creates a promise that has to be validated later. Now, follow the money after the loan is made. The borrower probably does not leave the deposit sitting there. They spend it. Maybe a business pays a contractor. The contractor banks somewhere else. Now, the borrower's bank has to settle the payment with the contractor's bank. This is where reserves enter the story. Reserves are not the same thing as the deposits you and I use. Reserves are central bank money held by banks. They are the money banks use to pay each other at the central bank. So when a customer at Bank A pays someone at Bank B, Bank A may have to transfer reserves to Bank B. If Bank A creates too many loans and the money keeps leaving, it can run short of the settlement money banks need. It can borrow reserves, attract deposits, sell assets, or slow its lending, but it cannot ignore the plumbing forever. This is why the phrase "from thin air" can mislead. The deposit can be created with a keystroke, but the bank has to survive what happens after the keystroke. In the United States, the old textbook story often centered on reserve requirements. A bank receives $1,000, keeps 10%, lends $900, and the process multiplies through the system. That story still teaches an idea, but it is not how modern lending is actually controlled day to day. Since March 2020, the Federal Reserve's reserve requirement ratio has been 0% for all depository institutions. That does not mean banks can lend infinitely. It means the old required reserve multiplier is not the main brake. The real brakes are capital, credit demand, profitability, regulation, funding, and settlement. A bank needs enough capital to absorb losses. It needs borrowers who want loans and look capable of repaying them. It needs the loan to make sense at current interest rates. It needs supervisors not to conclude that its balance sheet is reckless. And it needs enough liquidity to make payments as deposits move. This is the part where the story becomes less mystical and more interesting. Banks do not ask, do we have deposits sitting idle, as the first question. They ask, can we make this loan profitably, safely, and within our constraints? If the answer is yes, the deposit can be created. If the answer is no, no amount of keyboard magic makes a bad loan safe.
Look at the scale of the system. In March 2026, Federal Reserve H.6 data showed U.S. M2 money at about $22.7 trillion. Currency in circulation was only about $2.4 trillion. Reserve balances was about $3.0 trillion. In other words, the money we use is overwhelmingly not paper cash. It is entries in bank and money market balance sheets. And on the bank side, the H.8 release for the week ending April 29, 2026 showed U.S. commercial banks holding about $19.5 trillion of bank credit, including about $13.7 trillion of loans and leases. Their deposits were about $19.1 trillion.
That is the modern money machine, a banking system whose assets are loans and securities, and whose liabilities are the deposits the public treats as money. Now here is the part almost nobody explains clearly. When loans are repaid, money disappears. Suppose that same borrower pays back $10,000 of principal. Their bank deposit goes down by $10,000. The bank's loan asset goes down by $10,000. Both sides shrink. The deposit money that was created when the loan was made is extinguished when the principal is repaid.
Interest is different. Interest becomes income for the bank. It pays staff, shareholders, depositors, taxes, and operating costs. But the principal repayment destroys the deposit created by the original credit. So the money supply is not just printed upward forever by banks. It expands when new lending creates deposits faster than old loans are repaid or written off. It contracts, or grows more slowly, when repayment, defaults, caution, or high interest rates overwhelm new credit creation. This is why credit cycles matter so much. In a boom, borrowers feel confident and asset prices rise. Rising collateral makes banks more willing to lend. More lending creates more deposits. More deposits become spending or asset purchases. The system reinforces itself. In a downturn, the loop can reverse. Falling collateral makes banks cautious. Borrowers stop expanding. Loan losses eat capital. New credit slows. Repayments continue. Deposits stop growing as quickly. What looked like abundant money suddenly feels scarce. This is also why housing is so central. A mortgage is not just a family borrowing old savings. It is a bank creating a large deposit that allows the seller to be paid today, backed by the buyer's decades of future income. When enough of that happens, credit does not just reflect home prices. It can help push them. The same logic applies to commercial real estate, corporate borrowing, private equity, consumer credit, and government bond markets, although the mechanics differ. Wherever the banking system is willing to turn promises into deposits, purchasing power can appear before the underlying cash flow has arrived. But this does not mean banks control money alone. The central bank sets the environment. It sets interest rates, it supplies the reserve system, it acts as lender of last resort. It regulates, supervises, and in crisis can create central bank money directly through asset purchases or emergency lending. Commercial banks create broad money through lending. The central bank creates base money, like reserves and currency, and uses policy to influence how aggressively banks and borrowers create broad money. That distinction is crucial. If the central bank lowers rates, more loans may become attractive. If it raises rates, more projects fail the math. If it floods the banking system with reserves, banks are more liquid, but they still need capital, profitable loans, and willing borrowers. Reserves help the plumbing. They do not automatically force a bank to make a loan. This is why quantitative easing can confuse people. When a central bank buys bonds, it creates reserves. If it buys from a non-bank investor, deposits can also rise. But QE is not the same as a bank approving a mortgage or a business loan. One is the central bank changing the asset mix and liquidity of the system. The other is a commercial bank creating a deposit against a borrower's promise to repay. Both can expand money-like balances, but they enter the economy through different doors. So, can banks print money from thin air? The honest answer is, banks can create deposit money through credit. They do it by expanding both sides of the balance sheet. But they cannot create real resources, cannot ignore losses, cannot ignore payments to other banks, and cannot escape the cost of funding or capital forever. The power is real. It is also conditional. And that is why banking is so strange.
A bank is not merely a middleman between savers and borrowers. It is a licensed institution allowed to transform a credible promise about the future into money in the present. That power is useful when credit funds productive investment, homes people can afford, factories that produce more, businesses that earn enough to repay, infrastructure that raises future income. It becomes dangerous when credit mostly bids up existing assets, when lenders assume collateral can only rise, when borrowers refinance instead of repay, or when the system creates deposits against promises the future cannot honor. Then, the same machine that made money feel abundant starts deleting it through defaults, write-downs, and fear. So the next time someone says banks print money from nothing, the better answer is, almost. They create money from promises. The promise is the asset. The deposit is the money. The future is the test.